Forex trading psychology. Controlling emotions for success. Forex trading requires not only technical and fundamental analysis skills, but also a strong understanding of trading psychology. Emotions play a significant role in trading decisions and can greatly impact trading outcomes. Successful traders understand the importance of controlling their emotions and developing a disciplined mindset. Here are some key aspects of Forex trading psychology for beginners. Emotions and trading. Emotions such as fear, greed, impatience, and excitement can cloud judgment and lead to irrational trading decisions. It is essential for traders to recognize and understand their emotions and how they can influence trading outcomes. Emotions can create biases and cause traders to deviate from their trading plans and strategies. Develop a trading plan. Having a well-defined trading plan is crucial for controlling emotions in Forex trading. A trading plan outlines specific rules and guidelines for entering and exiting trades, risk management strategies, and overall trading goals. Following a trading plan helps remove emotions from the decision-making process and ensures that trades are executed based on objective criteria, rather than impulsive reactions. Practice discipline and patience. Discipline and patience are key attributes of successful traders. Discipline involves sticking to your trading plan, following predetermined risk management rules, and avoiding impulsive trades based on emotions. Patience is necessary for waiting for high-probability trading setups and not succumbing to the fear of missing out on potential opportunities. Risk management and money management. Effective risk management is vital for controlling emotions and protecting trading capital. By implementing proper risk management techniques such as setting stop-loss orders, limiting the percentage of capital risked on each trade, and diversifying trading positions, traders can minimize the emotional impact of losses and maintain a long-term perspective. Money management is also crucial for controlling emotions. It involves determining position sizes based on account size and risk tolerance. By risking a small percentage of capital on each trade, traders can reduce the emotional stress associated with larger potential losses. Accepting losses and managing drawdowns. Losses are an inevitable part of trading. It is essential for traders to accept losses as a normal part of the process and not let them negatively affect their emotions. Developing a mindset that views losses as learning opportunities and focusing on the long-term profitability can help maintain emotional stability. Managing drawdowns is also critical for trading psychology. Drawdowns refer to the decline in account balance from its peak value. During drawdown periods, emotions such as frustration or fear can arise. It is important to stay disciplined, stick to the trading plan, and avoid impulsive actions that can worsen the situation. Continuous learning and adaptation. The Forex market is dynamic, and traders need to continuously learn and adapt to changing market conditions. Embracing a growth mindset and being open to learning from both successes and failures can help traders control emotions and make better trading decisions. Staying updated with market news, studying trading psychology literature, and seeking mentorship or guidance from experienced traders can contribute to ongoing personal and professional development. Practice emotional self-awareness. Developing emotional self-awareness is crucial for controlling emotions in trading. Traders should be able to recognize when they are experiencing emotions such as fear, greed, or impatience and take steps to address them. Techniques such as deep breathing exercises, meditation, or taking breaks from trading can help restore emotional balance and clarity. Conclusion. Forex trading psychology plays a significant role in achieving success in the markets. By developing a disciplined mindset, following a well-defined trading plan, practicing risk management, accepting losses, managing drawdowns, continuously learning, and practicing emotional self-awareness, beginners can gain better control over their emotions and make more rational and informed trading decisions. Emphasizing the psychological aspect of trading alongside technical and fundamental analysis can contribute to long-term profitability and success in the Forex market.